It's an imminent crisis that threatens to crash the entire housing market. I'm your host, Steven Van Metre, and thanks for joining me today. With housing prices near record highs, mortgage rates rising, and support for the housing market being pulled, it threatens to crash the entire housing market. Let's pick this story up where we head over to the Wall Street Journal, who headlines how the Fed's policy shift is rippling through the housing market. The central bank has been the biggest buyer of mortgage bonds, but is now stepping back and borrowing costs are rising. The central bank has been the biggest buyer of pools of home loans since the start of the pandemic, and now it's reversing course, winding down its purchases and laying the groundwork to shrink its $2.7 trillion stockpile that's built up. These mortgage-backed securities, hot investments for much of the pandemic, are now all of a sudden selling off, sending mortgage rates higher. And the upheaval in mortgage bond affects households in a especially direct manner. Less demand for mortgage bonds means issuers must offer higher yields to attract investors. Of course, the issue here, which we will challenge, is that, of course, it takes people needing to buy bonds for interest rates to go down. Of course, that is the story you're being told, but I don't think there's a lot of truth. But let's keep going. And we'll see here that so investors must have to raise interest rates on the mortgages inside those bonds. Now, already the 30-year fixed mortgage is around the highest level since the beginning of the pandemic. As purchases wind down, it will disproportionately hit demand for mortgage-backed securities, said the executive vice president for capital markets at Guild Mortgage Company. And here you can see when we look at the monetary base, or is the Fed's balance sheet in blue, and you can see it rising against 30-year fixed mortgage rates. Well, you can see there might be a relationship here. Now, if you're struggling to see it, well, with a little bit of magic, we're going to invert the monetary base, and suddenly you can see that, yes, there appears to be a relationship. As the Fed's balance sheet increases, mortgage rates fall, and as the Fed's balance sheet plateaus, rates stay static, and as it goes down, or rises, shown inverted, that you see mortgage rate falls, and now all of a sudden mortgage rates are starting to rise as this is front running a balance sheet runoff by the Fed. But is there a lot of truth to that? Well, let's back up one slide where it's a little bit easier to see. And here you can see at the end of quantitative easing 2, rates rose as right at the end of the Fed's program and then came crashing down afterwards. Because what starts to happen is you'll see that rates will rise as if the market thinks the Fed's the only buyer. But really what we understand is that long-term rates are a function of economic fundamentals. They have to do with future growth and inflation expectations. And in the short term, it drives rates up. But you'll see, and we'll go back to the chart, they actually come down. So you'll notice here they came all the way back down. We see other events where here you see rates jumping on mortgage rates only to come back down. You see them jumping again as the Fed unwinds its balance sheet and rates actually went down. So what it tells you is perhaps economic fundamentals are the driver in the long term, but in the short term, sentiment matters even more. The recent market movers are in many ways the mirror image of what happened in the spring of 2020 as the nation shut down to stop the spread of the coronavirus. The Fed jumped into action saying it would purchase trillions of dollars worth of securities. Prices on mortgage bond climbed and yields fell, and this set off a record amount of refinancing. And here we can see from investing.com, looking at mortgage applications, they shot up after 2020 and peaked and now are coming down, but they're starting to tick back up. And the question you might ask is, why are they doing that? Because as you see, rates are rising, but look at last week that mortgage applications jumped, purchase applications, refinance applications. So the question is, why would people be jumping to get a mortgage? Well, if you're about to purchase a home, then you're probably eager to lock in your rate out of fear that rates are going even higher. In the short term, they can absolutely do that. But why would people be refined and potentially at even higher rates than they originally had? Well, they have more equity now, and with the economy slowing, people being out of work, maybe their businesses are struggling, or maybe they're just looking forward and saying, hey, maybe things aren't that good. As an insurance policy, they might be actually refining and cashing money out to help get them through a rough time. And that starts to make sense why people would actually be considering refining at a slightly higher rate than they had originally, was to extract some equity. Let's keep going, because what we see now is at the same time, businesses and individuals held on to cash in their bank accounts and decided to borrow less. And this gave banks trillions of dollars worth of deposits that needed a home. And I just want to reiterate that so many people still believe that the Fed actually purchases debt and gives the government money when that's not true. This is creating a bank reserve. And what you can see in this piece right here, that banks actually did and do use mortgage-backed securities to back back deposits. Now, they also use treasuries. They can use mortgage-backed securities. And I want you to be thinking about the risk that could be involved here if there's a crash in the housing market and what could happen to these mortgage bonds that are backed by deposits of people at major commercial banks. But let's flip back here. As we see, again, that gave banks trillions of dollars worth of deposits that needed a home. And if people are cashing out their refis and putting money in the bank, well, guess what? The banks are going to have to buy even more bonds. And some banks stowed that money in mortgage bonds, such as Bank of America had more than $500 billion of mortgage bonds on its books at the end of the last year. But with the Fed expected to lift rates soon, banks may take some of that money out of storage. Well, the real question would be is, where would they put it? Because unless those deposits are leaving, well, those bonds aren't going anywhere either. Now, they could be swapping those mortgage-backed bonds for treasuries. And let's look at the data, because that might actually make sense why they would consider doing that. And here we can head over to the H.8, and this is a weekly report from the assets and liabilities of commercial banks in the United States by the Fed. And here you can see mortgage-backed securities. The banks are holding nearly $3 trillion of them. And yes, backed by your deposits and mine too. And non-mortgage backed, these are U.S. Treasuries considered risk-free, sitting at about $1.7 trillion. So why might the banks shed some of these mortgage-backed securities in a period where rates are rising? Is it because rates are rising? No, it's because of the threat that what if the housing market crashed and people stop paying on their mortgages? What would happen to those bonds that are backing deposits? Well, they'd go into default, and now all of a sudden the banks have to look to the government. Hopefully those bonds are insured to try to get money. Meanwhile, they still have to pay depositors interest. So it might make some sense for the banks, in a sense, to shed some of their liability on these mortgage-backed bonds as the economy looks to roll over and switch over to treasuries, which of course we know are risk-free. So keep that in mind, that if people think the banks are in great position here, they're sitting on a lot of risk that the housing market won't crash. Well, they better hope they're right. Let's keep going, because we see now, as we shift over, the Fed officials stress not jamming brakes on the economy as hikes loom. And well, we know that Chair Jerome Powell declared back when the had the FOMC conference that officials were ready to raise rates at their next meeting to curb the strongest inflation in 4 decades. And he declined to give specific guidance on the policy path, apart from saying the support should be moved steadily and policy had to be nimble in responding to incoming economic data, which tells us that likely at the end of March, we're going to get a rate hike. And what Fed Chair Powell has also said that shortly thereafter, they would start to unwind their balance sheet. And we've been getting indications from the Fed that a vast majority of the unwind would be pointed at mortgage-backed securities, potentially sending rates higher, threatening to crash the entire housing market, creating an imminent crisis, as you can see. Now, if you're concerned about this at all when it comes to your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. There's a link in the corner and down in the description. You'll be glad you did. All right, let's keep going, because I want you to see just how bad this potential crisis could be. And we've got a little ways to go on this story. As we head over to Bloomberg, who says home builder stocks sink as Powell alludes to several rate hikes. And sure enough, here is ETF symbol ITB, the home builders, and all of a sudden home builder shares are crashing. And it makes sense because, well, what happens when the Fed pulls demand from the housing market by raising rates? What does that mean for home builders? Well, it means fewer people are going to want to buy homes. It means you need fewer realtors, fewer people doing mortgages, fewer people building homes, just a lot less people. And there's a lot of people that are employed directly or indirectly by the housing market. So when you slow the housing market down, well, guess what? You're going to slow the economy down with it. Let's continue on, where home builder stocks have been surging since mid-2020 as the pandemic pushed many people to work from home amid nationwide lockdowns. That spurred demand, with bidding wars breaking out across the country as would-be homebuyers fought to get a piece of the nation's slender housing supply. Meanwhile, builders faced clogged supply chains that lengthened construction times, further raising prices. And then we'll switch over to the Wall Street Journal, who headlines the U.S. home price growth slowed in November. So we're already seeing signs of a peak in housing prices, as S&P CoreLogic Case-Shiller National Home Price Index, which measured average home prices in major metropolitan areas across the nation, rose 18.8% in the year that ended November, down from a 19% annual rate the prior month. So again, seeing signs here that the housing market is peaking at a point where people are maxing out their mortgages, and that's a dangerous sign. If you remember the last time this happened, we had something called the Great Financial Crisis. Let's continue on, and then we'll kind of wrap up my views on this. As home prices are rising, but the pace of appreciation moderated as rising inflation approaching winter holidays siphoned purchasing power from many home shoppers' budgets. The home price growth is expected to slow further in 2022 as mortgage interest rates have increased. Well, normally when rates rise, prices fall. And then we'll head over to this headline. The U.S. new home sales exploded higher in December ahead of mortgage rate dip from Zero Hedge. It has this wonderful chart here showing that new one-family houses sold a month over month surged at 11.9%. But year over year remained down 14. So what you're seeing here is buyers are jumping in ahead of higher rates, trying to lock in their deals at a time where sentiment says that people don't want to buy homes, and yet they are. That's how afraid they are of inflation. So you can see here in this chart here, the University of Michigan buying condition for homes, while it has ticked up some, you can see remains at multi-decade lows as people say that houses are too expensive. But the risk here isn't that we'll see the exact repeat of the great financial crisis, because if you remember back then, what we had is a lot of subprime mortgages, and what were they sold as? Adjustable rates. So when rates went up, the payments went up with them, and we were in a period where people could not afford higher rates. Now we're in a situation where, due to the pandemic, people have bought bigger homes to work from home, and of course that means a bigger payment. But what if the economy lapses into a recession and we see a slowdown in the housing market that leads to prices going down? Will people be able to make their housing payment? Or will they look back to the great financial crisis and say, well, the government bailed us out then, I'll just not pay this time? And of course, if that happens, well, that imminent crisis is going to look pretty bad. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or other advice. It should not be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre on personal capacity. Opinions expressed in this video that do not affect the Atlas Financial Advising or Steven Van Metre Financial.